What's up, guys? Welcome back to Everyday Money. Glad to have you all here. As everyone knows, inflation is raging out of control. The prices of everything is pretty much going up through the roof. Everyone has felt it at this point via either fuel prices, the price of food, the price of energy, the price to fill your car up. And there's a lot of reasons why we have inflation going on right now, with one of the biggest ones being that we inflated the monetary supply by at least 5x in the last 2 years. Supply chain issues, the war in Ukraine is driving up the price of oil, and that has a large effect on the price of inflation. But the thing is that I keep hearing is people are saying, well, I will wait to buy XYZ. I'll wait to buy a car. I'll wait to buy a home. I'll wait to buy anything, stocks even, or investments or whatever. And the rationale is that they will wait until the price of these items comes down, because as everyone says, what goes up must come down, right? The answer is no, that is not correct. In the United States economy, typically in all markets, everything always goes up over time. There is always going to be bumps and dips in the road, but as what we're going to look at here in the next couple of minutes, everything pretty much forever has always gone up. The reason for this is that the government likes to have a small amount of inflation. Their target rate for the Fed is 2 to 3% inflation all the time. And you might say, well, why would the government want to have inflation? There's a reasonably good reason for this. And there's also the government's, what I like to say, their secret reason for this. The reason on the upfront is that a small rate of inflation is good for the economy. It keeps things moving. It keeps people buying things. It keeps people buying services, and it makes it so that people aren't waiting for the future. Because if you know that the price tomorrow of something is going to be more than the price today, you are likely to buy that thing today, especially if it's something that you need or something that you really want. You're going to buy it today versus waiting for the price to go up tomorrow, because you know it's going to be up 2 or 3% in the next year, and that keeps the economy moving. It keeps we're a consumer economy in the United States, and it keeps things going along. Versus if we have a deflationary period where the things tomorrow will be worth less than they are today. The thing is that people would likely wait to buy items in the future because they know that they're going to be cheaper. And that can create a downward spiral, whereas people wait to buy items, they have to price them even lower to get them to sell. That continues the deflation, and then it just, round and round again until you are in a deflationary spiral. So it's good for the economy in a small way for inflation to keep things moving along. The other reason that the government likes to have at least a little bit of inflation is because the amount of debt that they have on hand is truly an amazing thing. We're looking at around $30 trillion on our national debt, and for us to be able to continue to add debt to it and make the payments, we need inflation to make those dollars that we are paying for worth less over time. If you're looking at an average rate of inflation of 3% over the course of 30 years, essentially every bit of debt today will be almost worthless in 30 years down the road. And so they do need that in order to stay ahead of their debt payments. But when you look at any of these charts that we're about ready to look at through the St. Louis Fed, which is a great place if you guys want to get the raw data on any of these, any chart on pretty much anything you want, from inflation to the price of vehicles, to the price of homes, to the price or the average income, you can go to the St. Louis Fed and see this and see why, for the most part, we are never going to backtrack from the prices that we are on right now. At the very best, inflation levels off. These prices stay where they are because we actually cannot afford a deflationary period in the United States, and you're going to see why here in just a second. So first up, we're going to look at the Consumer Price Index for all urban consumers, and this is all items in U.S. city average. Now, what this entails is it goes for prices of food, clothing, shelter, fuels, transportation fares, service fees, and sales taxes. And as you can see, that basically after for the entire chart it goes up, but after about 1970 or so, it really starts escalating in the steepness of the chart. And during typical recessionary periods, you do get a slight pullback from the increase in cost of items and services, as you might expect, but the brief periods of pullback are dwarfed by the massive, upwards trajectory of this thing. And so you can see that the price for all items in U.S. city average has always gone up over time. The next one we'll get in here too is the median sales price for homes in the United States. And this is where people are going to say that they're going to wait for the crash. They're going to wait for the crash like 2008 because it has to happen, totally disregarding the differences in lending, the differences in supply and demand versus 2008 to the present. They just feel like it's going to crash because it has to, because the prices are going up so fast. The thing that they usually don't keep in mind, they don't look at this chart and see that the biggest crash on here was during that Great Recession 2008, and it was almost all of 20% before it started coming right back up. And as you can see on this chart, around recessionary times, you do get a slight pullback in the median sale price for homes, but over the course of time, those prices always go up, just like every other market in the United States and probably in the world. We're going to move on to used cars and trucks in the United States. And this is one where at least it doesn't go in a just straight linear fashion in an upwards trajectory. When you look at this, and a lot of people need to buy new cars right now and used cars. And we got this chip shortage thing going on that's also creating an inflationary, catalyst in the automobile market. You will see that in these two charts, that the cost of automobiles drastically increased after about 1975, and then they kind of level off around the late 90s, up until we've hit this pandemic thing in about 2020. In which case, they are to the moon, as they like to say. We see the same type of trend in the cost of new cars. Basically, until the late 90s, from 1975 until the late 90s, it's a pretty upward trajectory. Things sort of level off, and then in 2020, 2021, again, straight to the moon. Also, as I've said a million times before, the markets always go up. The stock market is no different, and for as far back as you can see, the stock market here, what we're looking at is the S&P 500, is on an upward trajectory. There are major dips for the 9/11 type of stuff, the dot-com bubble, the Great Recession, the December crash of 2018, the coronavirus crash when we first did lockdowns. And so all of these things are accounted for in here, but they always go up over time. Gasoline is kind of a different story. Gasoline is one of the few things that has not gone up almost every year and almost all the time. It has been very volatile. It goes up and down depending on world events, and it can fluctuate very rapidly. But as you see on this chart, although there are large up and down spikes on here, the trend overall is upwards over time, and that is just the way things are. This chart here, the one on the rate of inflation in the United States, is going to just kind of lay this all out. As you can see, everything above the black line there is a positive rate of inflation for that year. So even if it's declining, like from say 1980 to 1985, that is a declining positive rate of inflation. So we might have gone here from 13% down to 2%, but that rate of inflation is still upwards. The only year on this entire chart going back to 1961 where the rate of inflation was negative, meaning that we had a deflationary year and it went down by 0.35% in that 1 year out of, what are we looking at here, like 60 years or so. And so even during all the recessionary times that we had, only 1 year since 1961 has had a negative rate of inflation or a deflationary year for that entire year. The last chart that we're going to get to is the real median household income in the United States. And this one is kind of the one that people always look at and they say that the real income in the United States has not gone up in XYZ years. And why that's not necessarily true, the results aren't that great. In 1984, the real median income was $53,337, and in 2020, it was $67,521, which is about a $13,000, $14,000 gain over the course of 40 years. So that is not that great of a thing. So guys, with all of these charts in mind, and you guys can look up as many of these as you want, and they'll probably all be pointing the same way, is up over time. You can see that even if we reduce the rate of inflation back to that 2 or 3%, the prices are never going to come down significantly or over a long period of time from where they are right now. unless we have a major deflationary event, which I don't see happening. I don't see the federal government, the Federal Reserve allowing that to happen. We will not see a pullback from these prices ever again in our lifetimes. So take that for what you will, guys. It's not really either, bad or good or whatever. It will take some time for people that are W-2 salary, hourly wage earners to catch up to this rate of inflation that we're sitting at now. The chances of people getting a 7 or 10% raise over the course of this year are not that great. So as these go up and then they level off, it will take a while for wages to catch up to where they need to be in order for things to become affordable again for the mass public. So guys, if you like this video, give it a thumbs up for me. Even if you didn't like the subject, it's not that positive of a subject. But if you like it, you got something out of it, you got some information, give me that thumbs up. Hit the subscribe button down below. Hit the notification bell. I appreciate you guys watching today, and I'll see you in the next one.